Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at energy fuels.
If you find our talks useful, please consider subscribe, like, and comment underneath. And before we jump into things today, just a quick reminder that the VIP Algos link is below in the description. You definitely want to check that out.
Yeah, highly recommend looking at that.
So getting right into it, when you think about the whole AI revolution, right? You probably picture, I don't know, sleek server racks or just data floating in the cloud. It all feels so intangible.
Like it doesn't even exist in the physical world.
Exactly. But the cloud isn't in the sky. It is grounded in dirt and solid rock and in these massive humming power plants. You just cannot compute without immense amounts of power.
Right.
And you definitely can't generate that power without raw materials physically dug out of the earth. So today we are looking at the wealth building context of a company right at the intersection of that physical rock and the digital future.
Energy fuels. Ticker symbol UUU.
Yeah, and our goal today is to unpack whether their massive strategic pivot really justifies the premium valuation they have right now, especially with the crazy volatility we are seeing.
It's the brutal physical reality of all this digital innovation. I mean, the market is finally waking up to the fact that the next decade of tech, whether we're talking AI or electric vehicles or advanced defense systems, it's all bottlenecked by basic earth sciences.
Just raw materials.
Exactly. We are talking uranium for nuclear power, rare earth elements for permanent magnets, and vanadium for grid-scale batteries. And Energy Fuels operates across all three of those critical materials.
They're just sitting right in the center of that Venn diagram.
Plays perfectly, yeah.
But so looking at the fundamentals, this is where the tension driving the stock really lives, because on the surface, the engine is humming.
Yeah.
Top line growth is robust. Their trailing 12-month revenue growth actually accelerated to nearly 22%.
Which is fantastic.
It is. And the gross margin is sitting at a very healthy 34.58%. They've got pricing power. They're efficient. They are making real money on the ore they pull out of the ground. But here's the massive catch.
That's bottom line.
Yeah. The net margin is a staggering negative 82.7%.
Ouch.
With an earnings per share of negative 30 cents. I mean, that is a wild disconnect.
It is, and that specific disconnect between strong gross margins and deeply negative net margins is exactly what makes this company so polarizing. Like, if this were a structural failure, meaning they just couldn't produce uranium cost-effectively, it would be an immediate red flag.
Run for the hills.
Right, exactly. But this widening net loss is actually the result of a deliberate, highly aggressive strategic pivot. They are actively sacrificing short-term profitability to capture long-term market share.
Okay, so think of it like a highly successful local bakery.
Right.
They bake the best bread in town. They sell out every single morning. Profit margins on each loaf are just fantastic.
I love a good bakery analogy.
Right. But at the end of the year, their accountant is like, hey, you are massively in the red. And why? Because instead of taking profits, the bakery owners bought up all the local wheat farms.
I see where you're going.
They bought the delivery trucks, the milling facilities, the grain silos. They stopped just baking bread and decided to own the entire supply chain. And that is what Energy Fuels is doing. They are building a domestic, quote-unquote, mine-to-magnet supply chain.
Which is an incredibly capital-intensive endeavor. I mean, processing rare earth elements is not just crushing rock and melting it down. It involves this notoriously complex process called solvent extraction.
Sounds expensive.
It is a nightmare, chemically speaking.
Yeah.
Rare earth elements are incredibly similar to one another, which makes separating them just brutal. It requires massive specialized facilities, intense chemical engineering, environmental management, because the raw ore often has radioactive byproducts like thorium.
So historically, the West just outsourced all this, right?
Oh, absolutely. They just shipped the headache overseas, which led to a supply chain almost entirely dominated by state-sponsored competitors in Asia.
Leaving our tech companies, our auto manufacturers, even our defense contractors completely reliant on this precarious supply chain just to get the magnets that make their engines actually spin.
Right. So Energy Fuels is taking the cash from their profitable uranium and vanadium businesses and funneling it directly into building these specialized solvent extraction circuits here in the West.
So the moat isn't just the mineral rights.
No, it's having the domestic capacity to turn that raw ore into finished materials.
I hear that, but hold on. When I see a negative 82% net margin in a heavy industrial sector, my instinct is still to panic. I mean, burning 82 cents on the dollar doesn't sound like a brilliant moat. It sounds like a cash burning trap.
It's a fair concern.
How do we know they aren't just going to run out of money before this grand vision actually works?
Well, unlike a lot of cash-burning developers who have to constantly issue new shares just to keep the lights on, Energy Fuels is self-funding a huge portion of this capex through their existing operation.
Oh, so the uranium side is paying for the rare earth side.
Exactly. They're using the cash cow of uranium to fund the future empire of rare earths. And that strategy is what you're paying for with their premium valuation.
Right, because they trade at a price-to-sales ratio of over 34.
And a price to book of 4. You aren't paying for this quarter's earnings. You are paying for the strategic dominance they're trying to build for the 2030s.
Okay, so building a domestic moat sounds great, but it takes astronomical amounts of capital and time. So what are the upcoming catalysts driving demand fast enough to justify this massive gamble?
Well, first you have to look at the AI power grid. The broader market is finally realizing that AI power requirements are completely upending our infrastructure.
Right, because training a large language model takes tens of thousands of GPUs running at max capacity for months.
And those computing clusters cannot afford a sudden voltage drop. A data center cannot wait for the wind to blow or the sun to shine.
Right, they need massive, uninterrupted, 24/7 baseload power.
Exactly. And nuclear is currently the only carbon-free solution capable of delivering that at scale, which is why we're seeing this massive structural bid under uranium stocks right now.
And adding even more pressure to that is the climate macro environment. We are looking at rapidly developing El Nino conditions, significantly raising the chances of a record warm year in 2026.
Which means global cooling demands will spike.
Yeah, testing power grids to their absolute limits, that just accelerates the push for reliable baseload power. And then looking at the geopolitical map, we are seeing sustained conflicts like U.S.-Iran tensions and blockades driving oil prices above $100 a barrel.
Whenever oil gets into the triple digits, it fundamentally alters domestic energy policy. Governments have to accelerate their transition to secure domestic energy sources. It elevates a company like Energy Fuels into a matter of national strategic interest.
Okay, but what about near-term catalysts, like specific events investors should be watching for?
The first major one is the Q3 2026 earnings report.
Yeah.
That's expected late October or early November. Now, investors shouldn't obsess over the net loss figure.
Because we already know they're burning cash for the moat.
Right. Instead, you want to focus entirely on operational updates and the CapEx burn rate. Is the solvent extraction facility actually on schedule? Are costs contained? Or are they seeing those massive budget blowouts that plague complex chemical engineering projects?
And we also need updates on their uranium sales contracts, right? Are they locking in favorable long-term prices to secure that baseline cash flow?
Yes, exactly. And outside of earnings, the market is aggressively hunting for new commercial contracts, specifically in vanadium and rare earths. A major catalyst would be new contracts for vanadium redox flow batteries, or VRFBs.
VRFBs are so fascinating. Unlike lithium-ion batteries that degrade over time and catch fire, VRFBs use these massive tanks of liquid vanadium electrolytes.
Yeah, they can charge and discharge thousands of times with almost zero degradation.
They're physically huge, so useless for cars, but absolutely perfect for grid-scale energy storage.
Especially when paired with nuclear or renewables to stabilize the grid. If Energy Fuels secure supply contracts for that vanadium, it adds a massive new pillar of revenue. And the other big catalyst is rare earth offtake agreements.
Meaning a long-term contract where a Western defense contractor or an EV company agrees today to buy the magnets Energy Fuels produces tomorrow.
Exactly. Securing an offtake agreement validates the entire mine-to-magnet strategy. It proves the demand is real and buyers are lined up.
Okay, let's look at the technicals, because if the macro environment is this perfect, the chart should look like a rocket ship. But it actually looks like a roller coaster that just dropped off a cliff.
Yeah, the broader uranium sector is undergoing a very sharp, very painful reality check. And Energy Fuels is caught right in the crosshairs.
The technical chart is rough. The stock is sitting at around $11.30, down almost 6% on the day. Over the last 26 weeks, it has fallen roughly 42%.
It's sitting nearly 60% below its 52-week high of $27.90.
But, surprisingly, it still retains a 26% positive return over the full year, having bounced from a low of $8.16.
A 60% drawdown is a brutal test of conviction. It shakes out the weak hands. Plus, the stock has a beta of 1.59, meaning it's about 60% more volatile than the broader market. When the S&P takes a minor dip, Energy Fuels catches a severe cold.
But when the market rallies, it sprints ahead.
Exactly.
Moving on to sentiment, though, there is some serious internal confidence. Over the last 90 days, corporate insiders bought a net 95,730 shares.
Oh, wow, that's significant.
Yeah, 4 separate buy transactions by executives, 0 sells. That gives them a perfect insider maximized security purchase ratio of 100.
Insider cluster buying is historically one of the most reliable indicators of corporate confidence. These are the people seeing the daily production number.
And there is also a wave of speculative momentum. We are tracking market chatter regarding a potential merger between Trump Media and Technology Group and TA Technologies.
TAE is heavily involved in advanced fusion, right?
Yeah, alternative energy tech. Now, just to be clear, we are not taking any political stance here. We are strictly reporting on the market chatter impartially. But the mere speculation of that kind of high-profile capital moving toward advanced nuclear acts as a massive sector-wide catalyst.
It definitely brings retail eyeballs and institutional momentum to the space.
Okay, but let's pivot to the risks and the bear case. Because how is a normal investor supposed to stomach a 60% drop? Especially with the structural risks on the table, the wider uranium sector is correcting.
Right, commodity prices are pulling back.
And if uranium and vanadium prices fall further, the profits funding that rare earth facility dry up. The construction crews aren't going to pause billing just because spot uranium dropped.
That is the primary structural risk holding the valuation down right now. If they can't fund the build-out from operational cash flow, they have to hit the capital markets.
Meaning they issue new shares, which dilutes every existing share.
Your slice of the pie gets smaller. Yeah.
Yeah.
It's the classic valley of death for industrial transitions.
And there is another massive risk hanging over this sector that the AI bulls seem totally blind to. The whole thesis relies on the uninterrupted expansion of physical data centers. But these are just vast physical warehouses. Our analysis notes the reported destruction of an Amazon data center by the IRGC.
Right.
Doesn't the physical vulnerability of these data centers completely pop that unstoppable demand bubble?
We treat cloud computing like it's inventable, but it is deeply tethered to physical geography. If data centers become geopolitical targets, the whole economic model shifts. Insurance premiums skyrocket, construction slows due to security mandates, and capital gets defensive.
It grounds the hype instantly. If an adversary can just physically destroy a demand center, those projected energy requirements evaporate overnight.
It does ground the hype. But looking at the other side of that exact coin, those physical vulnerabilities reinforce why Western governments are desperate for a secure domestic supply chain in the first place.
Because the world is getting more dangerous.
Exactly. They cannot afford to rely on adversarial nations for materials needed to build defense systems.
So, bringing this all to our final verdict. The overall bullish score for energy fuels sits at a 7 out of 10. The current valuation, hovering around a $2.89 billion market cap, presents a compelling asymmetric entry point.
But the thesis requires a multi-year hold horizon. We're talking 12 to 24 months, minimum. You have to give the rare earth processing capabilities time to be built and ramped up to commercial scale.
And endure a brutal sector correction in the meantime. If you are trying to trade this weekly, that 1.59 beta is going to chew you up.
This is a structural, long-term play on domestic critical mineral independence.
So the question you have to ask yourself is, can you handle a 12 to 24-month waiting period on a highly volatile asset? Or does the dilution risk and data center vulnerability make this too precarious for your strategy?
It's all about your personal risk tolerance.
Absolutely. So if you found today's analysis useful, please remember to subscribe, like, and comment underneath. And don't forget, the VIP Algos link is right below in the description.
Definitely check that out.
But I want to leave you with one final thought to mull over. We talked about the strategic advantage of a domestic supply chain. But what if preference turns into policy?
Oh, that's an interesting angle.
If global trade keeps fragmenting, what happens if Western governments stop treating domestic supply chains as just an advantage and legally mandate them for national security?
If a defense contractor is legally prohibited from using imported rare earth magnets, the entire demand curve shifts overnight.
Exactly. How would that sudden regulatory shift redefine the valuation of a company that has already spent years building the only Western mine-to-magnet moat? Something to think about next time you look at the physical infrastructure running our digital world.